Hello students, today we are going to discuss another topic. We are in week 4 and we will be talking about bond valuation, and this is the application of the concepts that we learned in financial mathematics. Okay, so we are going to apply the the valuation concepts in for the bond and stock. Okay. Okay students, before understanding the topic of bond valuation, so first of all we know that the bonds as well as stocks, they are financial assets. Okay, they are financial assets, we know that. So companies, and there are two perspectives. One perspective is a corporate perspective, the other perspective is a market perspective or the investor perspective. Okay, company perspective, when we say the company's perspective, it means company is going to do financing. And when we say the market perspective, it means there are investors who are in the market to buy the financial assets. Okay, so it means the market, when I'm saying this market, is for the financial assets. Okay, so the companies, they issue two types of financial asset. One is bond and the other is stock. So the companies, they sell these two financial assets in the market, and when the company sells the financial assets, company gets funds. Okay, so we know that when we sell something, we get some funds. Okay, so company is selling the financial assets, and these people in the market, they are going to buy these financial assets. Okay, so when we buy, means we are buying bond and stock. So these are the financial assets, and buying the financial assets, or in other words, these people, they invest, right? They invest and when we say from a corporate perspective, it means they sell or do the financing. So when the buyers are in the market, of course, when there are buyers in the market, they are going to pay something. How much should they pay for when they are buying? How much should they pay for the bond and stocks? Okay, so when they are buying, so they need to ask how much should we pay. And when we say how much should we pay, it means we need to find the value. Okay, or in other words, we need to find the price. Okay, and so that is why we call it as bond valuation. When they want to buy bond and find the price, it is bond valuation, and when we do it for the stocks, so they call it as stock valuation. Okay, so this is basically the concepts. We are looking at this market perspective. It means when the companies, they sell the financial assets, these financial assets in the market, the investors, they would of course buy these financial assets, and to buy, they need to find the price. Okay, and the price is called the value, and this process is called valuation principle, valuation. Okay, and we will do the valuation using valuation principle. Okay, and what were the valuation principles? In the valuation concept, we learned some concepts that were compounding, right? And we discussed discounting. Okay, and in valuation concept, the discounting part will be used. Okay, and we simple discounting, and we used annuity. Okay, we will see the application of annuity and simple discounting, and also we will look at the application of perpetuity. So that is perpetuity. So using these valuation principle, we will find the price. Okay, and also we know that price of anything price of anything is equal to benefits. Okay, and we know that the benefits are future benefits. You don't pay or you don't value any benefit that is a past benefit. Of course you are going to value something that you are going to get in future. Okay, so future benefits, when I say, so these are the future benefits. So how much, for instance, you are will, if you buy something, you are going to get benefits for 4 years, right? So these are the future benefits. So that's why you are paying something for the benefits. So remember, the price of anything is equal to the benefits. If the benefits are higher, of course the price would be higher. If the benefits are lower, the price would be lower. So you actually pay for the benefits. Okay, next is, these benefits that you will get in year 1 is not equal to the benefit that you would have got in year 0. So it means we should find the present value. So the price should be equal to the benefit, future benefits I would say, but these benefits should be discounted so that I can compare our benefits with the price that you are going to pay today. Okay, so it should be value or price of anything is equal to the present value of future benefits. Okay, and the benefits can be in different ways. Depending on the assets, we have different benefits. Okay, so please remember this rule, said the price of anything is equal to the present value of future benefits. Okay, and when I say a price, present value, it means any benefit that you are going to get divided by 1 plus r power 1. Okay, benefit 2, 1 plus r power 2, and so on, right? Okay, so but if the benefits are equal, benefit 1 is equal to benefit is E2 is equal to benefit 3 is equal to B, right? Then we can apply the concept of annuity, right? So we can say present value of future benefits. Okay, so you see, you are actually applying the concepts of discounting to find the price. So this is, you need to remember, if you understand this principle, it will be very easy for you to understand the concept. Okay, so again we will look at the investor perspective, because investors are going to, or market perspective, because they are going to buy. Okay, and for instance, in the market there are price, so should they be paying for that market price or not? So that is a question. Now remember, there are two things, two prices. The price, let me write another thing, because you will say, sir, in the market the prices are already there, so what are they actually calculating? So for instance, if I just check any bond price for X bond, if I want to find the price, let's say its price is 980. So 980 is already there, so why am I calculating this price? Okay, remember, this is a market price. You might be willing to pay for this price, or you may not be willing to pay for this price. Okay, so this is a market price. Okay, but now you need to see whether this market price is equal to the benefits that this asset is going to give, right? So it means in the price you have market price and the price that you will calculate, okay, to know if market price is worth it or not, right? Okay, market price is easily available, you can find it. Okay, then this price is called intrinsic value. Sorry, I'm spending more time on this it would be easy for us to understand. Then we also call it as fair value. Okay, we also call it as value. The one that you calculate is called intrinsic value, fair value, or value. Let's say using this formula, the price that you got is 960. Okay, so it means using the formula, so using these formulas you got this price, but in the market it is 980. So you will say that, hey, in the market this is selling expensive, its price should be 960, but it is selling expensive, so you will not buy this asset. Okay, because you have used some valuation principle and discounted all the possible cash flows and then calculated this one. Okay, and you will say, hey, this asset is overpriced in the market, I'm not going to buy it. So let's say if it is 990, and you would be, according to the benefits, its benefit should be equal to 990, because the price of anything is equal to the benefits. So but in the market people are willing to sell at 980, so you will say that this asset is undervalued, so you will buy it. Okay, so these are the concepts that are very important to understand the coming topics. So you need to see that we would be doing the valuation. Okay. Okay, this is the lecture outline. We will discuss bond definition, bond terminologies, coupon bonds, zero coupon bonds, and why bond prices change, and bond theorem. So when we will discuss it, it would be easy for you to understand. Okay. Okay, if you see the bond definition says that the firm issue bonds to raise funds to finance their productive assets. Okay, so when I say bond, companies, they issue or sell financial assets, in this case bond, and to raise some funds so that they can buy real assets. So they sell financial assets and they buy real assets. Okay, so they do financing through financial assets and do investment through real assets, and the real assets I told you last time are plants, machinery, equipment. Okay, so the companies, they sell the financial asset, or in other words issue financial assets to buy their productive assets, mean their real assets. Okay, bonds are securities issued by government and corporations. So companies as well as governments, they both issue bonds to raise money from investors in exchange for promised future benefits, including interest payments plus the repayment of the loan amount at the end of the contract. So I will explain it. Bonds are debt instrument which receives fixed interest returns in the form of coupons. Okay, so these two definition, let me explain. Okay, so first of all, bonds are like when investors, they buy a bond, so they pay dollars and they receive bonds. So as an investor, what do I have? I have a bond. Okay, so maybe I have paid $1,000, I have this much money and buy a bond. Okay, so it means this bond is equal to worth 1000. Okay, but what is the benefit that I would get? Of course the benefit would be something, so I will get some extra, so that is called coupon rate. Okay, and then it is going to be for 5 years. So there are three aspects, this one, this one, and this one, three parts. Okay, so it means bonds are debt instrument which receives fixed interest rates in the form of coupon. Of course, which receives mean, in other words, the bondholder will receive but the company would pay, right? On bonds, company would pay fixed cost, and this fixed cost would be fixed return. Okay, fixed return for the investor, but for the company, of course, it is going to be cost and for specific period of time. Okay, so as an investor, if you see, as an investor I have two options. So let me draw it again. So as an investor I have $1,000. Okay, so for first few slides I will spend some time, okay, so that it's easy for us to understand the concepts. So this is company ABC. Okay, so company is selling bond. Okay, and then there is a bank also. Okay, so if if I invest this 1000 in bank, right, I will pay how much? 1000, and in return I will get some interest rate. And maybe if you are investing in the bank, of course you are investing for some time, so let's say for 2 years. Okay, so your investment in the bank is for 2 years, so you gave the bank 1000 and in return you are getting interest rate. You can also, if you are investing the same, instead of investing in the bank, if you are investing in the company, and you will give 1000 and you will receive a bond. Okay, so what would you get? Of course you will say that, hey, I am investing in the bank and getting this much of interest rate, let's say 10%. So what are you paying? So the bank, this is called interest rate, okay, that you're getting from the bank. But whatever interest rate this company is going to give you back is also interest rate, but we call it as coupon rate. This is the same thing. Coupon rate is the interest rates that the company gives you as a return, or company pay as a cost. Okay, so this coupon rate and this interest rates, they are similar things, but because this is coming from the bank and this is coming from the company, so that's why it's coupon rate. Okay, so how do you find the interest payment? So 1000 multiplied by 10% is equal to 100. Okay, so this 10% is called the interest rate, and this is called the your amount that you had invested, and this is called interest payment, right, if you invest in the bank. But what if you invest in the bond? You will pay 1000, you will get, let's say coupon rate is also 10%, so how much will you receive? So that is equal to 1000 multiplied by 10%, still it is same, that is 100, but we will not call it as an interest payment, we will call it as coupon payment. Okay, because it is coming from the coupon rate. So this is the face value, mean this is the amount that you are giving to the company, 1000, and this coupon rate, this is 100, is coupon payment. So this is just the difference. Okay, so interest payment is basically the company is also paying interest, bank is also paying interest, but we have different names for different investments. Okay, so this is, you can see, so after maybe after 2 years the bank will give you back your 1000. Okay, so it means 2 year is the maturity period. Okay, so similarly on bonds we have some maturity. After maybe 5 years company will give you coupon payments, and at the end it will give you back your money. Okay, so it means now if I draw a bond, typical bond, this is what I will get. On this bond there are three characteristics that you can find, that is the face value. Face value mean this bond when it was issued it is 1000. Okay, so face value is similar if you had invested 1000 in the bank. Okay, so your investment is 1000, and maybe on the bond itself this is written 1000, and then we have coupon rate, this is stated rate 8% for instance, so this is called coupon rate, this is similar to interest rate. And then there is maturity, let's say 10 years, so you will hold this bond for 10 years and you are going to get how much? 1000 multiplied by 8, 80 every year, so that would be coupon payment. So for 10 years, after 10 years, you are entitled to get back your 1000. Okay, so this is called the redemption price. This is also called redemption price, mean when 10 years would be over, you will get back your 1000. Okay, so these are the three characteristics of a typical bond. There is some uh, face value, okay, then we have coupon rate, and then we have maturity. Okay. So as an investor, students, you will learn the coming concept very easily if you understand this part. Okay, don't worry. So that's why I'm spending much time. So for instance, if I am an investor in the market, this bond is called X bond. In the market, the price of this bond is 900. Okay, so this is the market price. I know that this is. So should I buy this bond at 900? Let me calculate. Okay, so according to the market, the price should be 900. So it means its benefits are equal to 900. But what about me? What are the benefits equal to actually if I do calculations? So I want to evaluate this bond X. Okay, so as I know, the price of anything is equal to the present value of benefits, future benefits. Okay, so let me calculate it here, future benefits. Okay, so let me say this bond, what benefits this bond can give me. So let me say it is 10 years, 1 2 3 4 5 6 7 until 10. Okay, so what are my benefits if I buy this bond? So can you calculate the benefits? Yes, I can calculate. So benefit number 1 would be 1000 and 8%. I will get 80 every year, right? 80 every year until year 10. So these are benefits, right? So the present value of future benefits mean this is the future benefit, future benefit, future benefit, and future benefit. So I have identified my future benefits now. After that, I need to calculate the present value. Okay, so I need to find the present value. So these are the future benefits. First part I know, I can understand. When you find the price, first you know the benefits, and then you need to know the for the present value you need to know the cost, because price is equal to comparison between benefits and cost. Okay, so it means this bond is giving you 80 80 80. So this is annuity, I can understand. Plus at the end of the 10-year I will also get back my 1000. Okay, this is called the redemption price or the maturity value. But how should I discount it? So I know that 80 is my benefit, then 1 plus the 1 plus what should I do? Plus 80, 1 plus what should I do? Okay, so this is I don't know, because I can understand the benefits but the cost I don't know. Okay, here is a thing. So if you are investing in the bond, you are getting how much? 8%. So that is your benefit. But if you would have invested the same money in bank, the bank would have given you how much? Maybe 7%, or maybe 10%, or maybe 6%. We don't know. Okay, so this is called market interest rate. Okay, and we also call it as required rate of return. Okay, so it means because you are investing in this bond, you are getting 8%. But if the same amount is invested in the bank or in other investment, you will get maximum 7%. So 8% you are getting, and you are not investing in this investment. So that is your opportunity cost. That is opportunity cost. So it means I should invest I'm getting 80, but if I invest somewhere else, I will get how much? 7%. Okay, so that would be 1.07. So this is your opportunity cost. Okay, so this is how you actually calculate the bond price, and when you find the answer, your price is, let's say, 1050. Okay, so you see in the market it is 900, but in according to you its benefits are actually equal to worth 1050. So it means in the market people are not pricing it well. Even you would be willing to pay 1050. So it means you are not paying 1050. Of course you will get at 900, right? But this is price according to you, and this is called the intrinsic value. So according to you, the price, even if the price goes maximum 1050, you can still buy it, but still in the market its price is 900, you would buy it. Okay, so when you discount something, of course you say what is my opportunity cost. So this is your benefits versus cost, present value. Okay, so this is how you calculate. Now I think it should be very easy when we will discuss this valuation principle, if you have understood it. Okay, so first of all, valuation first principle, value of financial is equal to the present value of expected cash flows. Okay, so the benefits, whatever the benefits are, we call it as cash flows. Okay, there is one thing that I should tell you at this stage about cash flows. So any benefits, whatever is the benefit, you just call it as cash flow. Okay, so in later stage I will explain why we call benefit as cash flow. So this is actually the preferred one. So you are going so any benefit, whatever is the asset, you are actually calling that benefit as cash flow if it is a financial assets. Okay, so for financial assets all the benefits are called cash flows. Okay, so this is you need to remember. So in the bonds, what are the expected cash flow? They are coupon payments, coupon payment, that is 80 80 80 80. Okay, so these are the benefits, future benefits, cash flows. The price of a bond and shares are determined by calculating the present value of the future cash flows arising from the investment. Of course, we know that we calculate the present value of the future cash flows. Thus, to evaluate a bond or stock, okay, because they are financial assets, we need to estimate all the future cash flows. It means we need to find these future cash flows 80 80 80, amount and timing. Of course, how much is the amount and how much is the time. Okay, number one, first of all we need to find the cash flows, then we have to discount discount the future cash flow at a discount rate. So this in this question, in this slide, they are saying these rates depend on the riskiness of the cash flow stream. Okay, number one, for instance, if I invest in the bank is giving me 7%, and this is 7% means 70. Okay, if it is 1000, and in this case 8% is 80. So this is giving me 8%, so it's okay. Because this is risky, so that's why it's paying 8%. Bank is less risky, it is paying me 7%. But it is, if it is very much risky, so bank is paying you 7%, so you may say that no, I need not 7% in my, so it means it is paying 8%, so it should at least pay 9%. Okay, so you are paying extra, demanding extra how much? 7 plus 2% extra from your other investment. Okay, so that is your required rate of return. In the previous case we use 7%, but depending on the riskiness of the asset we can change it. Okay, but we should have some threshold or maybe some starting point, and that is 7% here, that is market interest rate. Okay, now the rate should be appropriate to the risk associated with the securities. So every security has its own risk. stocks are actually very risky compared to bonds. So the stocks have the higher required rate of return, right, compared to bonds. So I think you know what is the difference between the required rate of return. Required rate of return is basically your opportunity cost of investment. Okay, if you had invested in some other investment, how much maximum would have received in that investment? If you do not invest in here, how much would you uh, receive in other investment? That is 10%. Okay, so that is opportunity cost or the required rate of return. Now once we know that there is this is a bond, okay, so 1000, let me write face value, coupon rate and n. So we can classify the bonds based on these characteristics, this one based on this and based on maturity. Okay, so first of all we classify the bond based on coupon rate. Okay, but there are bonds which has zero coupon and the bonds which has coupon rate. Okay, so we can classify coupon bonds mean the bonds which have some coupon rate. Okay, so pay regular coupon interest payment, you see coupon interest payment which are fixed for the life of the bond. So it means there are bonds which have all these three characteristics, they are called coupon bonds. Okay, pay the entire original principal at the maturity. Of course we know this is 1000 will be paid at the end of the at the end of the maturity, that is called the redemption price. Okay, redemption price, that is actually this face value. Okay, return comes from, basically the return actually comes from the difference between the purchase price and the principal value received at maturity and periodic coupon payments. Okay, this is we can understand. So let's say you were here, you had bought this bond at 800 from the market. Okay, so the market price when you had bought this bond today, and after 10 years and you will receive 80. So coupon payments you will get plus the difference between the two prices, because you are going to get how much, 1000 at the end of the period minus how much, 800 that you when you had bought this one. Okay, so coupon plus this difference. So this is why this is saying that difference between the purchase price and the principal value received at maturity, or we also call it as redemption price. Okay, next question is, how are the cash flows of the coupon bond different from an amortizing loan? Okay, last time you remember when you had calculated the present value is equal to C divided by R, 1 minus 1 over 1 plus R power n, you had calculated C. Okay, C was called installment in the amortization table, remember? So this C had two parts, one was interest rate and the other was we calculated the principal. Some part was interest and some part was principal. But if you see this cash flow is simply future value multiplied by coupon rate. Okay, so in amortizing cash flow you pay some interest rate, okay, and you pay some part as principal. But in bond, if you see, you pay the principal at the end of the year, right, at the end of the maturity, but the coupon payment has no principal. Okay, so please listen again. In amortization cash flows, the cash flow has some part as principal and some part as interest rate, but the coupon payment has no principal included. Okay, so this is just interest rate, but principal is not there, because principal you are going to get back at the end of the maturity. Okay, so that is the difference. Okay, so this is the bond where we have all the three characteristics 1, 2 and 3. So if we keep coupon rate as 0, so that would become 0 coupon bond. Okay, so in the 0 coupon bond, this is 0, so future value is there, n is there. Okay, so it means we have some future value we have here today. Okay, so there are no periodic payment 0 0 0 0. Okay, so it means the price should be equal to future benefits. So these benefits are not here. Okay, can you see any benefit? No, we cannot see any. So it means we have some face value, this is face value, or maturity value, you can write it as like that, divided by 1 plus market interest rate, and I will call it as yield to maturity or the required rate of return. At this point I will actually call as interest rate. Okay, because in later part I will explain what is yield to maturity. So that is n. Okay, so that is a simple formula, but if you see, if you write the formula for this one, okay, let me write the formula for you. For this bond, price should be equal to future benefits 80 80 80 80. Okay, so C, they are equal, so we can apply the present value of annuity divided by I or R. Okay, so you can write it as R, 1 minus 1 over 1 plus R power n. So this is application of annuity, as you can see, plus you will also going to get the maturity value 1 plus R power n. Remember, this R is not coupon rate, this is market interest rate. Okay, now but here we have only face value, so we can apply the concept P is equal to maturity value 1 plus R power n. So this is simple discounting. As you can see, in the 0 coupon bond the formula is simple discounting, and in coupon bond the formula is annuity. Okay, annuity plus simple discounting. So this is annuity, this is simple discounting. Okay, based on coupon rate we classified them. Now let's see what are the bond terminologies. This is very important. Let's say, assume that it is May 15 2010. Okay, today is 15 May 2010. Okay, today, and the US Treasury has just issued securities with May 2015 maturity. So it means maturity is how much? 15th May 2015 or May 2015, but because there is no date here, so it is May 2015. So from 2010 to 2015, it is also May, it is also May. So how many years? 5 years. Okay, and the par value is 1000. So it means when the US Treasury issued this bond, the par value was, or the par value means at the price that is written on the bond, face value or the par value, same thing. Okay, face value, par value, same thing, and a 2.2% coupon rate. So that is 2.2% coupon rate. It means this bond is going to pay 2.2% every year for how many years? 5 years, with semi-annual coupon. Okay, so this coupon is annual, but we have to convert it into semi-annual, and the years are 5 years, so we have to convert these two parts. Okay, so coupon rate is 2.2% divided by, because it is semi-annual, so it would be 2, and n is equal to 5 into 2. Okay, the first coupon payment will be paid on November 15 2010. So to be November 2010 first payment. Okay, if you move from here to here, of course they are going to be 6 months. Okay, then next will be in here, and it will follow like that. What cash flow will you receive if you hold this bond until maturity? So until maturity, if you keep this bond, so you will be getting these benefits until the end of the year 5. Okay, so let's see how can we find it. It means we need to find the price. Remember students, this bond, when this was issued, this bond might have some price in the market. So there could be some market price of this bond, but we are not concerned with the market price here. Okay, so we are going to calculate our price based on the benefits, not the market price. Okay, then we will compare our price, that is the intrinsic price, with the market price to see if we need to buy it or not. Okay, so the face value 1000, also known as par value or the principal amount, and also face value, we also call it as face value. Notional amount used to compute the interest payment, typically repaid at maturity. Of course, this notional amount means this is the rate which will be multiplied with the coupon rate, right? Coupon rate to get the interest payment. Okay, so how do we calculate this coupon payments? Using this notional principle, and usually standards increments such as 1000. Normally we have the standard is that the face value is 1000, but it depends, 1 million or maybe 10,000, 100,000, even 100 could be the case also. Okay, so maturity is 15 2015, so that is here. Okay, at which the principal amount is payable, term is 5 years, repayment date means your repayment date of 1000. Okay, so that is called redemption price. And coupon rate 2.2% determines the amount of each coupon payment. So this is also, if the whatever is the interest rate on the bond is called coupon rate, but if you invest in the bank, it is called interest rate. Okay, now we are going to calculate the price. Okay, so the first of all is promised interest rate is 2.2%, 2.2%, because this is semi-annual, so we are dividing it by 2. Okay, so that would be adjustment in the coupon rate to make it semi-annual. So once we get this coupon rate, okay, we can then multiply it with the face value to get the coupon payments. So if you see, this is coupon payment, it is equal to coupon rate, that is 2.2%, multiplied by face value. Okay, so we will get the annual coupon payment, but because this is semi-annual, so they have done it like this. Okay, 0.2, same thing. Okay, and then after that they have multiplied it with 1000. So coupon payment is equal to coupon rate multiplied by face value. Coupon rate is 2.2% divided by 2 multiplied by 1000. So this is 11 paid at after every 6 months. So 11 11 11 for 5 years, and at the end of the period you will get 11 plus 1000. Okay, so there are total how many cash flows based on the coupon payments? 10 cash flow plus you are going to get this one. Okay, so how can we find it? Of course, you will apply the formula of annuity. Let me apply the formula here. So the price is equal to C divided by R, 1 minus 1 over 1 plus R power n. So this is the formula of annuity plus maturity value divided by 1 plus R power n. Some people write it as FV, so don't get confused with that. Okay, and some people also write RV, redemption value. So that is 11 divided by what is the, okay, so in this question there is one information that is missing, that is R, opportunity cost of investment or required rate of return. Okay, so we need to find this rate. Let's see if the question is given you this information. Okay, so this rate actually in this question this is not given, but we know that this is the rate if we had invested it in the market. Okay, if it in the bank we would have got it, so that's called required rate of return. Okay, market interest rate. We also call it as market interest rate because if you had invested in the bank you would have got maybe uh, some interest rate. Okay, so this is also called discount rate, but there is an other words we also call it as yield to maturity. Okay, so this part I will explain, but this is a different name. Okay, so in bonds specifically when we discount this R, we know that this is required rate of return, this is also interest rate, or this is a discount rate, but we in bonds we specifically mention that this is yield to maturity. Okay, so it means if you invest in this bond for 5 years and you are going to get 11 11 11, okay, 10 cash payments, so how much should you expect? Okay, when you are buying the bond here, the market interest rate is, let's say it's 3%. Okay, and the coupon rate in this question is 2.2%. So it means this 3% you should use as a discount rate, and this is called yield to, this is called the yield rate. Okay, but because you are discounting all the cash flows until maturity, so that's why we are calling it yield to maturity. So it means this 3% is being used for the discounting of every cash flow. Okay, so this interest rate or the required rate of return in the bonds is called yield to maturity. Okay, you got this concept? It means because market interest rate is 3%, I come again. So you are using this discount rate for the discounting of every cash flow. Okay, until maturity. Okay, when we will end here, so 1 plus 3%. The bond is giving you 2.2%, but you are expecting 3%, so it means your required rate of return from this bond is 3%. Okay, so this is called yield to maturity in bond. So previously I didn't write it indently so that I can explain it to you later. Okay, now you can see the word here, price, also known as intrinsic value. The price means the one that you are going to calculate. Okay, the one that you are going to calculate, or the current market price, the present value of the promised future cash flows. Yield to maturity, also known as yield, right? Yield on the bond, discount rate, required rate of return, or market interest rate, or we also call it opportunity cost. The average rate of return of an investment in a bond that held to its maturity. I just explained this part, held until maturity, 3% you used. The discount rate that set the present value of the promised payments equal to its current market price. So this is another thing I will explain. Okay students, this point is very important. Okay, so you need to understand that you are here, okay, and this is a bond, 2 years bond, 10% coupon rate and paid annually, and this is the face value, and this is the timeline accordingly. Okay, and if you had, although in the market, if you had invested in the bank, you would receive 12%. So you will call this as, it means this bond is giving me 10%, but if I invest in the market I will get more. So this bond should at least give me 12%. It means it should give me 120, not 100. Okay, so it means because this bond is giving you 10%, so that is why its price is 1000. Okay, but if it is giving you more, of course the price should be different. But you know that when the bond is issued at this rate, the company cannot change the price. So this is, once it is there, company cannot change it. Okay, so this is what the company has promised. But if you are thinking that the company is giving me 10% and the bank is giving me 12%, why should I invest in the company and it is giving me 10%? Okay, then even if you so the first solution is you straight away invest in the bank, okay, for 2 years. This is one solution, okay. But the problem is if you deposit it in the bank, at any time you cannot sell your investment, but if you have bond you can sell it anytime, so there is some facility in the bond, okay. So you say that, okay, I am investing in this bond, so this bond will give me benefits of 10 divided by my discount rate should be now 12%, right? So it means these benefits are actually, these are benefits, but my cost is 120. Can you see that? So this is your benefit, but you're losing how much? 120. In other words, your opportunity cost is 12%. Okay, so this is how much? This is 10% actually that you're getting, but your opportunity cost is 12%. So benefits divided by cost is actually the price, right? So that's why you say my discount rate, my opportunity cost would be 1.12 now. Okay, so this is the first case where you know your discount rate, or where you know your YTM, your market interest rate, your required rate of return, right? You know these things. So this is a very simple situation. You have some market rate and you get it very easily. Okay, then let me put another situation for you. Okay student, this is a situation here. So previously in that case you had your yield to maturity. Okay, so it means previously it was easy for you to get your yield to maturity. You found it through bank rate, that was 12%. Okay, so that was a simple case, yield to maturity was given. But let's say you are not given yield to maturity in the question. Okay, so yield to maturity is not given in the question. So this is all you have. You have the benefits, but the cost you don't know. Okay, so the cost actually you don't know. Then how can we find the yield to maturity? So in this case you will say that in the market, in the bond market, the price is 850. Then you can find this 850 should be equal to all the benefits, right? So it means in the previous case we had we calculated the price because YTM was given, but let's say YTM is not given. Okay, then you will use the market price, okay, and then find this yield to maturity. Okay, so yield to maturity, how do you find it? Because it requires some complex mathematics, so I will explain it later. But in this situation you will find YTM based on market price. In the previous case you find price based on YTM. Okay, so this was the first case and this is the second case. Now in bonds actually you normally are supposed to find price, YTM is given, very easy. And in another situation you are given the market price. Okay, then you are asked to find the market price is actually equal to the benefits, right? Every price is equal to the benefits. In the second case you are asked to find YTM. Okay, so there are only two variations in the bonds calculation. Either you calculate the YTM, when you are calculating YTM, so it means market price is given, and if you are finding the market price or the price, it means YTM would be given. Okay, so these are the two situations. So if you see the statement, the discount rate that sets the present value of the promised equal payments to the current market price of the bond. You see this definition? Okay, the discount rate that sets the present value of the promised future benefits equal to the current market price is called yield to maturity. So that's why I wrote all this for this purpose. Okay, So this is very easy now. Valuation of coupon bond. Bond is equal to the present value of coupon payments plus present value of the face value, and as you can see, this is the application of annuity formula and this is simple discounting. So this is how you calculate it, right? Same formula. And what is y here? Y is YTM actually. Okay, so because I have written the formula already, so I think you will get it. So either you can separately do it like here, or you can calculate it separately. So the price of the bond is equal to C divided by YTM, 1 minus 1 over 1 plus YTM power n, simple, plus maturity value or the face value or the redemption value 1 plus y power n. Okay, very easy, because coupon is given, so this is the formula of coupon bond. When the coupons are not given, then we will be only left with this part of the formula. Okay, when coupons are 0, so it would be simple discounting. Okay, so let's take a question. Consider a 30-year bond, this is maturity, with annual coupon payments. One bond has 10% coupon rate, one has 5% coupon rate, and one has 3% coupon rate. If the yield to maturity, you see, yield to maturity is given already, of the bond is 5%, what is the price of each bond per 100 face value? So it means face value is 100, and these coupon rates are different, 10%, 5% and 3%. Okay, and the yield to maturity is 5%. I told you in the first case, when YTM is given, then you need to find the price actually. Okay, but if price is given, then you need to find YTM. So we are solving the question for the first case. So that's very simple. So maturity is 30 years, 30 years is the maturity, and coupon rate is 10%, 10% multiplied by coupon payment is equal to coupon rate multiplied by face value. 10% multiplied by 1000, it would be, sorry, the face value is 100, not 1000. So that is 10, same formula, and this is the price. Okay, so similarly we can do it for the 5% coupon rate and 3% coupon rate. We can solve it, and if you see the answers here, we can learn something from this, because there is a reason for giving different coupon rates, bonds with the coupon rate. Okay, so if you see, yield to maturity is constant, that is how much? 5%. Okay, yield to maturity is 5%, and coupon rates we have 3 classifications. Number 1 was 10%, number 2 is 5%, and number 3 is 3%. Okay, but yield to maturity is constant. If you see in the first case, coupon rate is higher than yield to maturity. So when the coupon rate is higher than yield to maturity, if you see, the answer should be higher than the face value. Okay, so it means on the face its price is 100, but in the market it is selling at 160. So it means it is selling at premium. In other words, if I can just relate it like this, let me explain. Okay, the bond is giving you 10% on 100 for 30 years, but in the market, if you invest in the market is giving you how much? 5%. Okay, so it means in that case, even the price is 100 on the face value, but if you see, company is giving you higher than in the market. Okay, so it means if you invest it in the bank will give you 5%, but the company is giving you 10%. So you are even willing to pay more than 100. So that's why it is premium. Okay, so yield to maturity is less, your required rate of return is 5%, because if you don't buy this bond you will get 5%, but if you buy this bond you will get 10%, right? So even if you are willing to pay more than 100, and how much are you willing to pay more? That is 76, so that's why the price is 176. Okay, so it means if the coupon rate, if the company is giving you higher than the market, of course it should be selling at premium, right? Then if the company 5%, 5%, if the company coupon rate is equal to, bond rate is equal to YTM, so it should be selling at 100, sorry. So people will, so we will call it as it is selling at par, at par. This is 176, this is 100. If you see, the answer would be 100. So CR, if coupon rate, if the bond rate is equal to the market interest rate, then it is 100. In third case, if coupon rate is less than YTM, company is paying less 3%, but the market is paying 5%, the people are not going to pay you more. People will ask for the discount, okay? So it will be selling at discount, and in this case that is 69.2. If you see here, 69.2. Of course, company cannot reduce this 100, or company is not going to give you discount. You will get discount in the market, okay? So in the market, this bond should be selling at 69, not 100. Okay, so this is how, this is not very much desirable, because you can invest in the market to get 5%. Okay, so this is why, this is the reason that you are given 3 options in this question. Now the same thing that I just explained is here. When coupon rate is equal to 5% at par, when coupon rate is higher than yield to maturity, above par, or above par mean above 100 or above face value, right? At premium, if it is less, then it is selling at below par or at discount, because there is an inverse relationship between YTM and bond price. We can see that divided by Y, 1 minus 1 over 1 plus Y power n. Even if you don't have the coupon bonds, so still we have inverse relationship, okay? So you see, you have inverse relationship between the YTM and bond price. YTM mean whatever you will get in the market, okay? Your required rate of return or interest rate. So this is actually, I'm repeating again and again. Students normally they get confused in these terms. Okay, common mistakes. There are some common mistakes in calculating bond value. First of all, we fail to make sure that all bond data are consistent with the bond compounding period. Normally, the coupon rates are annual, semi-annual, quarterly. So if we do not transform this coupon rate based on the compounding period, there could be some errors, okay? So we need to actually adjust this. Most bonds pay coupon interest rate semi-annually, that is twice a year, okay? So what are the 3 missing information in this question? Sometime you may be asked to find the coupon rate. Face value you don't need to find, that's given, or maybe you can be asked to find n, or in other words, if YTM is given, you can find price, and if price is given, then you can find YTM. So you can see, you are supposed to find YTM, coupon rates, as well as number of payments. If any of this information is missing, we can find it. Okay, let's see the first case. A bond with a face value of 1000, okay, par value, and a coupon rate of 6%, has a 10 years to maturity. What is the intrinsic? Intrinsic means the value that you will calculate of this bond if the market interest rate is 10%. So this is YTM. Assume coupon payments are paid semi-annual. So we need to find the price. That is a very simple case. You see, coupon payments, 1000 is the face value, multiplied by 6%, that is 60, because it is semi-annual, so we can do 30. Or in other words, you can do coupon rate divided by 2, that is same thing, 6% divided by 2, 3%. So what is coupon payment? 3% multiplied by 1000, you will get 30. Okay, 30 YTM. Okay, YTM is 10%. Of course, we also need to adjust it semi-annual. So 10% divided by 2, 5%, and this is the price. As you can see, the YTM is 10% and the coupon rate is 6%. So you are expecting more in the market. Your required rate of return in the market is 10%, but you are getting less in from this bond. Of course, it will be selling at below par or discount. Okay, now this is a very interesting case. In this question, we are going to find yield to maturity of a coupon bond. Yield to maturity for a coupon bond is difficult, okay, because we have coupon bond and we have zero coupon bond. Yield to maturity for the zero coupon bond is easy, very easy. Let me write easy. Okay, and this one, it is difficult, so we need to use interpolation, or in other words, last time I also teach you, that is called hit and error, trial and error, hit and trial or try and error, you can name anything. Okay, we call it as interpolation. Okay, let's see. So I told you yield to maturity, when yield to maturity is not given, what is given? Market price is given. Okay, so we will see that market price would be given in this question. Consider the 5-year is N 1000 bond face value with 2.2% coupon rate and a semi-annual coupons. If the bond is currently trading for a price of 9633.11, what is the bond's yield to maturity? You see, because we want to find the yield to maturity, we need to this price should be given, the market price. Okay, so we can solve it by trial and error method or solve this using financial calculator. Financial calculator is very easy, you can easily find it. Okay, but with the trial and error method, you see this price is how much? 963.11 is given. Coupon payment is 11, 1000, 2.2%, mean this is annual, but if we convert it, 2.2 divided by 2, it 1.1 multiplied by 1000, so it is 11. Okay, and 5 years, so we can convert it into 10, so this is the same thing. But how can we find this? Why? For this one, we need to find trial and error method. So let me solve this question using trial and error method. And if you see, once you get your yield to maturity through the financial calculator, it's very easy, but let's say we are calculating it using the trial and error method. Okay students, if you see, we can solve this question using interpolation. So this is the formula for the interpolation, we already know. If you remember, in the previous lecture, we calculated it using trial and error method. Okay, so interest rate lower plus present value at the rate when you are using lower rate. Remember one thing, because doesn't mean low L doesn't mean lower present value, it means the present value when you are using lower rate plus present value. Now what is the present value? That is the current market price. Okay, so that is also known as PV naught. Okay, plus PV at lower rate minus PV at higher rate, the difference between higher rate minus and lower rate. Okay, so this is 963, the current price. We need to use two rates, one rate that gives us the higher PV and one rate that gives us the lower PV. And we know that there is an inverse relationship between the price and coupon rate. You see, if we increase coupon payment, yield to maturity or the interest rate, the price will decrease. So it means if we use the lower rate, we are going to get, if you are going to use lower rate, we will get higher price. Okay, so that's why it is PVL. If you are using higher rate, you will get lower PV. Okay, So that's why we need to take two rates that gives us the higher PV than this, and one yield to maturity that gives us lower than this. Okay, so we need to assume two rates and apply it in the formula. Okay students, after solving this, you can see that I just solved it. When I'm using the lower rate 5%, my answer is 877.47, and when I'm using 10%, my answer is still down. Okay, so it means one rate I got it. One rate at 5%, you can expect that your answer would be 877.47, but this is, it means this rate according to it is higher rate. Okay, so it means I should not use this because the difference between this price and this price is very high, and this price, sorry, this price and this price is very high, so I should not use 10%. So it means at 5% I can get it. Okay, so one rate I keep 5%, I need to change, so it means 5% would be then PV high. Okay, because still according to this price, this rate is relatively higher, so it means 877. One answer I need more than 963, so it means I should reduce the rate from 5% to down. Okay, so let's see. So what is the, let me put another rate. Okay, you assume any rate, remember one thing. Okay, at, let's say it is 2%, and this is PVL. I'm considering it now PVL because at higher rate you still had lower, and this rate was still higher than this one. So at PVL at 2%, your answer is, so this is your answer. Okay, so now we are actually successful at this stage. You see, at this stage you are now successful. So yes, we got one rate that gives us answer higher than the this one, and one rate higher than this one. Now we can use it. So interest rate or yield to maturity, so now interest rate is equal to lower rate, interest rate lower plus present value at lower rate plus PV naught divided by PV at lower rate minus PV at higher rate, and the difference between lower rate and higher rate. So what is the lower rate here? So that is that we use, that is 0.02% plus PV at lower rate was 691.13. PV we need to make 6 equal to 963.1. So, okay student, just a little bit correction. If I use 2%, sorry, it should be there is a mistake here. This should, answer should be higher, sorry. Yeah, so this should be the answer. Okay, so I made a mistake at 2%, but in case if you want some answer higher, you can still see, if you use even 2.2% coupon rate, if you use 2.2% coupon rate, your face value, the answer should be equal to this one. So you can still use that, but let's say I'm using 2%. Okay, now higher is equal to 1009.47 minus 963.11, 109.47 minus 877.47. Okay, then we have higher rate is 0.05 minus 0.02. Sorry, this is interest rate higher minus interest rate lower. Okay, let me calculate it. Okay students, the answer is 3%. Okay, so this is called YTM, and this answer should be equal to what we have calculated from the financial calculator. And if you see in the financial calculator, so this is 1.5 for every 6 months, but if you multiply it with 2, we will get 3%. Okay, so same answer, you can do it. Okay, so what is the criteria? How do we determine the two rates. Normally if the coupon rate is given, at coupon rate your market price, when coupon rate is equal to uh, if you assume one rate as the coupon rate, the price should be 1000, then you have to assume another rate. Okay, so to calculate the second price, in this case if I had assumed 2.2%, I should have taken 1000. So that was easy, one part was easy, higher lower you can find. Okay, so this is simple adjustment. Remember one thing, coupon rate is always stated in APR, so that is always stated as annual APR. But when we convert it, YTM sorry, can be, and we have to convert it. Okay, when coupon rate is given, we actually do the conversion, and YTM could be APR if it is annual. If it is semi-annual, then it would be EPR or quarterly EPR, right? So EAR is basically the adjustment. And remember one thing, when we use EAR, when we have two different choices and we need to compare that. Okay, remember that thing in EAR in lecture 3, I guess. So we do the transformation, so you need to look at the transformation rates. Okay, so EAR was equal to 1 plus APR divided by M, right, power M minus 1. So you need to do that. That was the conversion. Okay, next topic is zero coupon bond. In the zero coupon bond, we have coupon equal to 0. Okay, so you see that if you have bonds here, so in this bond we have face value, we have coupon rate, and we have N. So when it is 0, so it means you cannot find the coupon payments. So you have 0, 0, 0 coupon payments, and then we have only face value. Okay, so this is a very simple case. In for zero coupon bond, you only use the simple discounting. Okay, so so it means this is the pricing formula for the zero coupon bond. And in this question, if you are given price and if you are given future value and asked to find YTM, then it's very easy to find YTM in this situation. Okay, so very easy. So the bonds, zero coupon bonds, are normally they don't pay you regular coupon payments, but they are issued at discount. For instance, if this is a bond and it was issued, this is the face value and this is 0 and it is for 5 years. Okay, so when this bond was issued, it was issued, let's say 800. Okay, so for 5 years, so it means this was the issuance price. So they normally are traded at discount because there are no interim cash flows. So what is the motivation for the people to buy this bond? Because there are no coupon payments. So why should I buy this bond? It is because it is sold at discount. Okay, so when at the maturity, I will get back my difference. Okay, so it means for the coupon bond, for zero coupon bond, the cash flows are actually 0 coming from the interim cash flow plus difference, 1000 minus 800. Okay, so this difference is your return. But in coupon bonds, you have some coupon plus the difference in the prices. So okay, so if you read this, it means the same thing. You see, it trades for discount. So here is an example of zero coupon bond. The current market interest rate is 5%. It means this is yield to maturity. What is the price of a 5-year zero coupon bond with a face value of 1000? So very simple. So this is 1000. So you are here. If you invest in the market, you will get 5%. So this is your YTM. So simple, do the discounting, and this is the price. Okay, in this question we are going to find yield to maturities. Suppose the following zero coupon bonds. When there are zero coupon bonds, YTM is very easy to find. Okay, are trading at the prices shown below per 100 face value. So this is the face value 100, but this is 0, but maturities are different. Okay, so 1 year, 2 year, 3 year, and 4 year. So we need to find the, when it is a 1 year bond, you see the price is higher when it is 2-year, price start getting lower when maturity increases. Why? Because uh, higher the maturity, higher would be the discounting. If something is here at year 4, of course when you will discount it, you will discount it for 4 periods. It means the answer would be lower compared to the, if something is at 3, you will discount it for 3 periods. If it is at 2, you will discount it for 2 periods. So the purpose of this question is actually to make you familiarize with this concept that higher the maturity, okay, lower would be the price. And okay, let's calculate yield to maturity. Present value is equal to FV1 plus R power n. So in this question price is given, so you need to find actually yield to maturity. So 1 plus yield to maturity power n is equal to Fv over P. Okay, so that would be 1 by n minus 1. Okay, so this is the formula you can see. And if you calculate yield to maturity for 1-year bond, yield to maturity is the lowest. Okay, for if we increase the maturity, yield to maturity start increasing. So there are two takeaways we can see. Number 1, maturity, if maturity increases, price decreases. Okay, number 2, when maturity increases, yield to maturity also increases. Okay, because we don't know what will happen in the future, so our required rate of return will increase. Okay, so in other words, if you give a loan, you have two people, you have two friends, means friend A and friend B. So he has come to you to take a loan for 5 years, and he has come to you to take a loan for 1 year. Okay, so who will you charge more? Of course to A, because he is taking 5-year loan. You don't know whether he would be able to pay or not, but this person, 1 year, so there are chances that he will pay you back. So your interest rate will be higher to Mr. A compared to Mr. B. Okay, so this is the situation here. If the maturity increases, yield to maturity also increases. So these takeaways, please remember these one. Okay, next question is, let me see that. Okay, why bond prices change? Number 1, zero coupon bond always trade for discount. This is, we know that. Okay, coupon bonds may trade at discount or premium depending on the YTM. Okay, first of all, zero coupon bond always they are always at discount, while coupon bond they have 3 forms. 3 forms mean they can sell at par, mean when CR is equal to YTM. They can sell at premium when CR is greater than YTM, and they can sell at discount when CR is less than YTM. Okay, so most issues of coupon bond choose a coupon rate so that the bonds will initially trade at or very close to par. Of course, when the bond normally when the bond is issued and par value is 1000, when the bond is normally issued, the issue is nearly at par. Okay, nearly or very close to par. Maybe it is selling at 990 or 999, but maybe once it is in the market, okay, after some time, the bond price may either go up or either may go down depending on the market interest rates. Okay, so let's say if in the market this is the face value and bond was issued at 10% coupon rate and for 5 years. Okay, so if in the market interest rate decrease, so it means 5% is the interest rate. Okay, so it means if you invest in this bond you will get 10%, but if you invest in the market you will get 5%. So what will happen? People will start will 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 start buying this bond, right? So in this case YTM coupon rate is higher than YTM, so bond will start selling at premium. People would be willing to pay more than it has in the current price. Okay, so it means more than this par value, sorry, more than this par value. But what if in the market the interest rate increased to 15%? So it means people can now invest in the market. Why would they buy this bond? Even if they want to buy this bond, they should they will discount it. They'll discount these benefits, 100 benefit with 150, right? 15%, I'm saying this is 10%. Okay, so this 10%, 1000 benefit is not equal to actually one to what they are actually losing. So that's why when the market interest rates go up, the price of the bond will go down. So it means, and also this is market interest rate. Number two, with the time, okay, if you see 0 and 10, so if you are here, you have so many benefits. How many benefits? You are going to get 10 benefits. But let's say you were here, okay, how many benefits? Just few benefits. Okay, so the closer we get to the maturity, lesser benefits we are going to get, right? So only few benefits we will get compared to if we are here. Here the benefits are higher, here the benefits are very low. So as we know that the price is equal to benefits, when the benefit is low, price will also be low. So when the benefits are greater, price will also be higher. Okay, so when time passes, bond get closer to its maturity, the price will also change. Okay, so two factors, market interest rate and time. Now first let's look at the market interest rate. As we know that the price is equal to C divided by market interest rate. So there is an inverse relationship between the bond price and the market interest rate. So when the market interest rate they go up, the price will go down and vice versa. So this is written here, high market interest rate, lower prices, lower market interest rate, higher prices. Okay, so this is an example that market interest rate is 3% today. Okay, this is the coupon rate, and when the market interest rate is YTM is equal to coupon rate, of course the face value is 1000 and the market price is also 1000 and the yield to maturity is also 1000. So market interest rate means same thing, right? So this is, you see, this is same thing. So this is the first case. Now let's say the market interest rate decrease from 3% to 2%. What will happen? Because you see that CR is now higher than YTM. Okay, so people would be willing to pay higher. So that's why the answer is 1082. Okay, but the remaining maturity is 9 years still, and the price would be higher than the face value because market interest rate went down. So lower market interest rate, high fixed bond prices, lower fixed rate bond yield. Okay, so it means this yield is still 2%. This is actually the market interest rate. Okay, so this question is showing you if we change the price, what will happen to, if we change the market interest rate, what will happen to the prices. Market interest rate means YTM. Okay, so let's say if the interest rate increase from 3% to 4%, so it will not change this part, this will be the same. Okay, but this part is gonna change because now YTM is higher than the coupon rate, so it should sell at discount, and that is 925. Okay, so higher the interest rate, lower would be the price. Okay, now let's see what is the effect of market interest rate on bond prices and yield. Yield mean yield to maturity. Okay, when the market interest rate, normally interest rate is changed by the central bank, right? When the central bank changes the interest rate, it automatically affects the prices because Central bank rates, interest rate affects YTM and YTM affects price. Okay, the coupon rate promised by a company over the life of a bond issue cannot change. Of course, coupon rate is not gonna change. If the company has already issued bond at 10% and for 5 years, company cannot change this coupon rate. Okay, but in the market, of course, interest rates are changing and YTM is also changing. Okay, but coupon rate is not changing, as it is a contractual obligation to maintain that, but the interest rate in the market often change. So coupon rate doesn't change, they will change. Because they will change, so that's why it is going to affect our price. If the market interest rate go up, the bond is no longer an attractive investment compared to the bond of the same type that are newly issued at a higher coupon rate as set by the higher YTM. Okay, let's see. If the market interest rate goes up, so it means compared to 10%, new market interest rate is 12%. Okay, so this bond is no longer an attractive investment because people will start asking you to pay 12%. Okay, but because you cannot pay 12%, so they will require the discount. Okay, or in other words, they will keep investing in other bonds that are giving similar bond that are giving you 12% coupon rate. Okay, so this is the concept. Okay, the investor would prefer to invest in a bond in the market rather than invest in the existing bond issue unless they can buy the bond at a discount. This is the same thing. Okay, so the investor would prefer to buy new bond instead of this bond because this is now paying higher rate. So even if they want to buy this bond, they will ask you to lower the price. In other words, the price of the bond drops to match the market expectation, as we know that. So this bond's price will change to meet the market expectation. Now market expectation is 12%. Okay, is this the mind mapping? I created it for you. So you see that we are doing the valuation, and valuation is for the financial assets. Okay, and for the bonds as well as for the stock. In this part we are looking at the bond, and first of all we looked at the bond classification based on maturity. There is a perpetual bond. Okay, and based on the coupon rate we have zero coupon bond and coupon bond. Okay, in this question, in these slides, actually let me see if we have perpetual bond here. Okay, in this slide, actually I don't know why we missed the topic for the perpetual bond, but this is very simple because in the perpetual bonds the discussion is, we normally do more discussion for the coupon bond and the zero coupon bond. But if it is a perpetual bond, of course, if you see n would be infinity, so we will be only left with C divided by YTM. Okay, so we are not even going to get back any of the redemption price. So let me explain it to you. So then there is another bond where we have maturity, we have 1000, we have 10% coupon rate, but this is infinity. Okay, in this situation, so the price of the bond is equal to C divided by YTM. The practice question will be given in the tutorials, so don't worry. So 1 minus 1 over 1 plus YTM power n, and then face value 1 plus YTM, maturity value power n. Because n is infinity, so this part is going to be equal to 1. So we will be only left with C over YTM. So remember, this formula is for perpetuity. Okay, and the bond is called perpetual bond. So we will do some practice questions for the perpetual bonds in our tutorials. Okay, so based on maturity we have this one, and based on coupon rate, when we classify, we have coupon bond and zero coupon bond, and these are the formulas. After that, for the coupon bonds we have three things, because the zero coupon bond they always sell at discount, but coupon bonds we have three pricing mechanism. YTM higher than CR discount, YTM less than CR premium, YTM equal to CR would be at par, and the bond theorems are price is inversely proportional to YTM. Okay, they have a negative relationship for a given change in the interest rates. Changes in price of the long-term bond is higher than the changes in the prices of the short-term bond. And lastly, as for a given change in the interest rate, changes in the price of the lower coupon bond is higher than the changes in the higher coupon bond, uh, in the bond with the higher coupon rate. Okay, so that's all the mind mapping, and thank you so much.